Hi, welcome back. I have to confess that if a week and a half ago you'd asked me to value the Adani Group, I'd have said, no way, I'm not interested. I'm not interested in valuing a family group company with political connections. But events in the outside world have made it necessary that I visit this company. Let me set the stage. We're in the midst of what I call the rising India story, where a lot of Indians and non-Indians believe that the next decade, for good reasons and bad, is going to be the Indian decade. High growth, with India taking on the role that China did for the last 20 years. And that might or might not be the case. But let's face it, the India rising story took a hit a week and a half ago when the Adani Group was targeted by Hindenburg, short-selling group in the US. Now you're saying, why would targeting one company cut at the heart of a story for an entire country? Because the Adani Group is not just another company. It's a company that is tied to Indian infrastructure, which, as we all know, is the great missing piece in the India story. It's also a group very closely tied to political power. So it is, whether you like it or not, tied to the Indian government. And as it has played out, you've seen the India rising story getting tested. And the reactions are, in a sense, telling. The Adani family's first reaction to the Hindenburg Group's report was to play the patriotic card, that these were foreigners trying to attack not just the company, but the country. And the Adani Group has lots of supporters on that side. But there are quite a few people, and many of them are Indian, who believe that the report just reinforces what they've always known, or at least, they felt that that was going on in the background with the company. I'll make a confession. I know very little about the Adani Group. I have nothing invested financially or emotionally in the company. I don't do consulting, so I don't particularly care what companies think about me. And if you're looking for advice based on what I think about Adani, you're probably looking at somebody who's not well informed to give you that advice, even though I'm going to try. I am going to argue that the ingredients that have led to the Adani short-selling targeting are ingredients that are not specific to Adani. What are they? First, you got an ambitious family group company that is obsessed with control, and I'll come back and back this up. Second, you got a financial market where momentum trading not just dominates, it dominates wildly over financial fundamentals. And thirdly, you got a capital market, banks and equity investors, where governments and regulators often put their thumbs on the scale. It's not quite a fair game. And all of those, I think, play out in the Adani Group, but they also play out in lots of other Indian companies. So let's set the stage. As I said, I knew nothing about this company, so the first thing I had to do was go learn about the company. And I discovered it was a company that was founded in Gujarat as a trading company. And isn't every Gujarati company started as a trading company? That might be just my stereotyping talking. But they started as a trading company in the late 80s, and by the mid-90s, 1994, when they went public, they'd started into the infrastructure business with one port in Gujarat. They were still very much a regional company, but they succeeded. That port was a cash cow. They grew, and you come into this century and they start to expand into other infrastructure businesses. I'll come back and fill in the intermediate, the transitional period, but I'm going to jump forward to 2023. At the start of 2023, if you looked at Adani and asked, what businesses are they in? I'm going to do something I do very infrequently at the company. I'm going to go to a slideshow from the company that captures what the company is doing. Often there's a lot of selling in these slides, so I try to avoid them. But this slide is kind of descriptive. It tells you what the Adani Group, at least the publicly traded components of the Adani Group, are involved in. There are renewables, gas distribution and pipelines. There's ports, there's airports, there's cement. And there's a food business. If you look at every business other than the food business, you look for common ingredients. They're big infrastructure businesses. In fact, the Adanis were investing in businesses that everybody else was running away from in the last 20 years. Big infrastructure businesses, huge investments needed, long gestation periods, and perhaps a need for regulatory or government approval to keep going. So this is in 2023. Adani is now a large logistics infrastructure company with a small, I wouldn't even say a small food arm, with a food arm. Now, as you look at the company and you say, well, that's a lot of boring businesses, this is a company that's risen in the market ranks. 10 years ago, if you looked at the Adani Group, and remember this is in a country full of family group companies, the Adani Group would not have made the top 10 years ago. 5 years ago, it had just barely broken into the top 10. I think it was the 10th largest family group. But if you look at the start of 2023, it had clearly made the jump. There were 4 Adani companies in the top 20 Indian companies in terms of market cap. And there were 3 other publicly traded companies, and cumulatively the Adani companies have a market cap of close to $220 billion. These are all in US dollars, just because I think you can do it in any currency you want. $220 billion. Collectively, the Adani Group companies were worth more than Reliance Industries, which is India's largest company, but also happens to be the flagship for the Ambani Group. So the Adani Group, by the start of 2023, had made this transition into becoming one of the largest family group companies in Indian market cap terms. Incidentally, because Gautam Adani owns so much of the Adani Group, he was the second richest man in the world at the start of 2023. Another point on which Indians could congratulate themselves for having made the top 10 list. So this is where things stood just a few weeks ago. We'll come back and look at what's happened since, but before we do that, I want to fill in the middle. How did the Adani Group get from being a small Gujarat-based family group company to not just a national company, one of the largest family group companies in India? So I started by looking at operating metrics, in particular revenues and operating income over time. And you can see that the company's revenues have gone from very small numbers to very large numbers between 2002 and 2022. Now you'll notice that there is a dip in 2016 that's pretty substantial. Looks like they lost almost half their revenues. That's a little deceptive because this is the Adani Enterprises, the flagship company. And in 2015, they spun off Adani Port, Adani Power, and Adani Transmissions, big chunks of the company, and made them independent companies. This is a company that's had an almost uninterrupted growth in revenues. That is the most successful part of the story, is how much they've grown revenues. But even as they've grown revenue, notice that their operating margins are small. In fact, they're going in the wrong direction. The operating margins for the company in the most recent 2 years were about 3.6%. So this is a company that has grown revenues, but in terms of profitability, has slim profitability. Now, if you're an optimist, you're saying, but as they grow, the margin should improve, right? Well, these are infrastructure businesses. These infrastructure businesses tend to have low margins. You're never going to see 40% or 30% margins in these businesses. So there might be a slight improvement. How much we can debate, but it's not going to be as much as you think it's going to be. So that's revenues and operating income. Now, to grow your revenues in infrastructure business, you have to make investments in infrastructure. And as revenues and operating income have grown, they've been backed by investments. And I capture how much the company has invested by looking at invested capital. It's one of the few numbers where we trust accounting book value, but invested capital looks at book value of equity plus debt minus cash. I also net out goodwill and investments in other companies. But if you look at the invested capital at Adani, you get the same kind of picture as you got with revenues. The build up through 2015, the spin-offs of the 3 companies, reducing the invested capital, and the build up again. And as with the revenue graph, there's a sobering number. While the company makes money, the return on invested capital it makes is 3%, 3.18%. Now, we'll later look at the cost of capital within Adani, but I guarantee you its cost of capital is well above 3.18%. Does it mean that the company is in bad businesses? Not necessarily. There will be improvements in these margins as infrastructure investments age. But again, the improvement is not going to be 25, 30, 35% returns on capital. If you're lucky, it might go to 10%, 11%, or 12% returns on capital. The sales to invested capital looks at how much revenues there are for invested capital, and there again, you notice the same kind of statistic. This is a company in capital-intensive businesses that's not making much money, at least as of the moment. Now, to make all those investments, you had to come up with funds, right? Now, in some companies, there might be enough internal funds from retained earnings, but as we saw, the Adani Group does not have that much in earnings. So I went back through the statements of cash flows for the Adani Enterprises. And I'm focusing primarily on the Adani Enterprises rather than all 7 companies because it gives you a window into the entire group. And I look to see where they raised the funds to cover all those investments. And it's a no contest. For much of their life, much of their corporate life, this group has raised capital from debt. 91% of the funding between 2002 and 2015 came from debt. When I say net debt, it's the difference between debt issued, which brings in cash, and debt repaid. Net equity is the difference between equity issuances and dividends paid and stock buybacks. So 91% to 9% debt over equity. In 2016 and 2021, it's even worse. They actually raised almost nothing from equity, but they continued to pay dividends, which is why the percent from net equity is negative. And they made it all up with debt. In effect, they were borrowing money to pay dividends. And then you get to 2021, the last 18 months, and clearly there seems to have been a shift in policy. There's far more coming from net equity. Debt still dominates, but equity is now almost 18%. Some of this might reflect pushback they might be getting from lenders saying you're getting over-levered. Some of it just might be, the desire to tap into equity markets at really high prices. But you can see for most of its life, this group has raised its funding through debt rather than equity. And as it's used more debt than equity, no surprise, its debt load has stayed high. Now, you can measure the debt load by looking at debt as a percentage of capital, book value, market value. On a book value basis, you can see that this company has 57% debt, 43% equity. It's a pretty highly levered company. It looks much better on a market basis, especially in the last 18 months. But that's because the market value of equity has soared. Now, a more telling statistic that you can focus on when you look at debt is the interest coverage ratio. The interest coverage ratio is operating income divided by interest expense. It measures the buffer the company has. So the way to read the 1.44 is there's 1.44 rupees of operating income for every rupee of interest expense. That's not much of a buffer. The safest companies often have interest coverage ratios of 6, 7, 8, 9. This is 1.44. This is a heavily levered company. Now, before you jump down their throats, remember this is in a sector, infrastructure, where a lot of companies do what Adani does, which is borrow a lot of money, have a slim buffer. So this might be as much a reflection of the sector they're in as it is of the company. However, it is interesting that they have not made any equity issuances. Part of that might be driven by the sector, but part of it I think also comes from the fact that this is a family group that's intent on control. In fact, the best statistic you can look at to see how intent they are on control is to look at what percentage of the shares across the Adani companies that is held by the Adani family. And this is public information. It's not some secret information so nothing that I've said so far comes from the Hindenburg Group. This is all in the public domain. So if you looked at the holdings of the Adani companies at the start of 2023, 72.5% of the shares outstanding are held by the Adani family, either through a family trust, through trade line, which is an extension of or 4 companies that are controlled by the Adanis. These were 4 companies that they disclosed. The rest are held by foreign institutional investors, big chunk of that. The Life Insurance Corporation is the largest Indian investor in this company. Retail investors are a tiny little slice of this company. This is not a heavily retail invested company. Now, what does this have to do with debt? This is a company clearly with a family not only has a lot of control, but has been unwilling to give up that control. If you look at the percentage that the Adani family holds of these companies, it's almost not budged over the last 10, 20 years, last 10 years as the company has grown. So perhaps the dependence on debt is as much a reflection of the sector as it is of the family's desire to maintain control. Now, the picture I painted of the Adani Group is kind of a mixed picture, right? Revenue growth, low profitability, lots of debt, controlled by a family group. But the market, at least in the last 18 months, has fallen in love with the company. One way to measure how much the last 18 months deviates from the rest of the group's history is to look at standard pricing metrics, PE ratios, price to book, EV to sales, EV to EBITDA, and take a look at 2021 March through September 2022 and look at the price earnings ratio, 214 as opposed to 15, price to book 6.7. Clearly something broke open in the last 18 months where the markets, for whatever reason, have soared for the company. So that's where we are, and if we'd stopped 4 weeks ago, that's where my historical assessment would have stopped. But of course, Hindenburg has rocked the boat with the document that they released to the public just a short while ago. Now, this document runs to tens and tens of pages, and it's something. I mean, I'll be quite honest. I do not like these types of disclosures where you throw hundreds and hundreds and hundreds of contentions against a wall and hope something sticks, because you're then reading through this thing. Is this big stuff? Is this small stuff? So here's what I did. I went through the short selling thesis and I looked for the core critiques that they were making, the core issues that they were bringing up about the company. And as I see it, there are three big issues that Hindenburg Group and other short sellers see in the company. The first is their contention that the company is cooking the books, overstating profits, understating debt, making it look like they're healthier than they are, and that they're being aided and abetted by auditors who are either too young or too inexperienced to catch the fraud. I'll come back and back that up a little. So the first is a contention about accounting fraud, that the numbers you're seeing for the publicly traded Adani companies, are not numbers that reflect reality. The second is an argument that through shell companies established primarily in Mauritius, 38 companies through Adani family members, that they've been manipulating the price. They've been pushing the price up, and doing so with the desire of using the higher market price as the basis for borrowing more money. So that's the motive they claim for the price manipulation, but that they're manipulating prices and toying with the rules on listed companies in the US. There's a certain percentage of shares that are supposed to be held by non-promoters, people who the family group, and that they've been toying with those rules. And thirdly, there's a subtext in the Hindenburg report of, if not corruption, institutional inaction, that Indian regulators, banks, and institutional investors, especially the LIC, are looking the other way, that they are, at best, and maybe aiding and abetting the company because of political pressures. You know what? The reason that report found a ready audience is the Adani Group primed their audience for something like this, right? So, about the connection to the Adani Group and the people with political power. You know that the company is secretive. You've heard about those Adani brothers setting up shell companies. So this report kind of brought it all together for people who've always been suspicious about the company. Now, I read the report, and I have to confess that that there are good things in the report. I compliment Hindenburg for the research they've done, and if you look at the report, and you look at the details. Here are the details that I think stand out. The first is about the shell companies, all set up in Mauritius by, at least according to Hindenburg, by Vinod Adani, who's the older Adani brother and somebody who's been behind the scenes. You don't hear much from him. And according to Hindenburg, these 38 companies have been involving in stock parking stock manipulation, laundering money, and moving numbers in and out of the listed company financial statements. Hindenburg also claims that there are intra-party transactions, not only between the 7 publicly traded Adani companies, but privately owned Adani companies to pump up earnings, inflate revenues at the listed companies. The third critique that Hindenburg mounts is that Adani Enterprises and Adani Total Gas, big companies, are audited by a tiny and largely unknown auditing company, which has 11 employees, some of whom are 23 or 24. Again, implicit here is if they'd hired a reputable auditing firm, one of the big four, and been put through the audits, that some of the things they've done would be uncovered. The Hindenburg Group does make a big deal about the fact that to be listed on an Indian exchange as a family group company, at least 25% of your shares have to be held by people who are not part of the family group. And at least according to Hindenburg Group, they contend that by using these shell companies, Adani's been able to hide the fact that they actually own more than 75%, that they've been breaking the rule. Somewhere along the way, the Hindenburg Group also claims that that Adani has used its own shares as collateral. That's partly the motive for pushing up the price, because they can then borrow more money. And finally, there is guilt by association. All through the report, there are names that are named, some part of the family, some outside the family. These are names of people who are either been accused of fraud, have been found guilty of fraud, have been barred from trading. And there's some guilt by association that these are the kinds of people who are connected to the company. So I did read through the report, and as I finished the report, I said, you know what, it's a mix. It's a mix. There are some serious contentions, in particular these shell companies in Mauritius. That's not good news. I mean, you do not create shell companies in the Cayman Islands, in Mauritius, because let's face it, the Mauritius, you don't do it for business purposes. You do it to save on taxes. You do it to hide corporate governance issues. You do it to hide stuff. And if it is true that there are all these shell companies, then that is clearly something that would need to be looked at carefully, because in the process there will be laws that have been broken and rules that might have been bypassed. On the circumstantial evidence, and there's a lot of it, it is true that that these funds, that there are entities outside India who own Adani shares, and there's a suspicion, at least, that the family group is behind these shareholdings. And according to Hindenburg, that then leads to stock price manipulation. But I'm not convinced on that one, because to manipulate the stock price of a company with $100 billion market cap and try to double it, you need trading volume. You need to be able to show me that these entities don't just hold shares, that they pushed up the trading volume enough to be able to increase the market cap by that much. And I don't see evidence. There's some evidence on delivery volume being a high percentage from these companies, but that's neither here nor there, because you need to see huge jumps in trading volume to be able to push the price up this much. On the earnings manipulation, I really think the evidence is weak, and here's the reason. If the Adanis are manipulating earnings, they're doing an awful job at it, because if you looked at their margins and the returns on capital, the earnings are not good. If this is the best they can do, I don't know what the real world would look like if they were not manipulating earnings. No. So I think it's a mix of serious stuff, circumstantial stuff, and questionable stuff. I was a little puzzled by how much time Hindenburg spent on trying to convince us that the Adani Group was over-levered. Maybe they're selling short on the bonds, or they're trying to convince, they're hoping the equity will collapse if they make this contention. But remember, if that is the case you're making, then it has nothing to do with the con game. This is different. This is basically our argument. They've taken on too much risk. Borrowing too much money is not a con game. It's a risk. It could be a poor one. And in this case, it is entirely possible that Hindenburg is right on this measure, and that the Adani Group has borrowed too much. The current ratio is not a very good way of thinking about that they've borrowed too much. The interest coverage ratio, as you saw, is low. But I think that much of what Hindenburg says about the Adani Group, you could say probably about every infrastructure company. I don't think too many infrastructure real estate companies could pass the Hindenburg test for leverage. So here's my assessment. I'm willing to believe that the Adani Group has played fast and loose with exchange listing rules. They've been awfully close to 75% all through their life. I would be surprised if they haven't broken it somewhere along the way. I'm also willing to believe that they've used intra-party transactions to make themselves look more creditworthy than they truly are. And finally, even if they haven't manipulated the stock price, I'm perfectly willing to believe that they've used the surge in the market cap to their advantage in raising capital. So those are all bad claims. I'm willing to believe all of that. Now, but none of that is enough to make this a complete scam. These are things that you can push back on the company on. I'm willing to believe all of those. On the institutional front, I know that the banks, regulatory authorities, and LIC are going to get a lot of beating up after this. But I've learned, at least with these institutions, not to attribute to venality or corruption that which can be attributed to inertia and indifference. Now, if there's one word I would not use to describe any of these institutions, banks, regulatory authorities, and the LIC in India, it's that they're dynamic. They're everything but dynamic. They're risk averse, they're bureaucratic. And maybe what you see as bias in favor of Adani is just bureaucracy run dry. So when Hindenburg used the word, when they described Adani as the biggest con in history, maybe they did it for hyperbole. Because a con is when you have nothing at your core. There's no substance, that you're doing it purely to rip off people. And I think it's unfair to describe the Adani Group as a con using that definition, because I mean, these guys, this group is not just a competent player in the infrastructure space. It is, in my view, one of the more competent players. Now, after all, this is a space in infrastructure in India where you either have non-players or frauds and incompetence. Having flown into Indian airports constructed by groups not called Adani, I can tell you that when I fly in an Adani Group constructed airport, I feel more secure. It is actually better done. So it is a competent player. It might overreach on debt. It might play fast and loose with the rules, but it's not a con. It's, if you want to push back on the way it's run, I think it'd be better to push back on what it does that you don't like rather than to label it a con and kind of overreach. I think the way I think about the Adani Group is it's a company that's played the seams of the India story, because this India story has always had some weaklings, right? And the Adani Group has kind of zeroed in on these weaklings and taken advantage of them. And let me be specific. In spite of all of the broadening of the Indian economy, the rise of tech companies, this is an economy that is still dominated by family-owned businesses or publicly traded companies, family-controlled publicly traded companies. Now, there are lots of good things about having family-controlled companies, but there is one force in family businesses that I think often dominates everything else, which is the need for control, the desire for control. And in some family businesses, that desire for control overwhelms everything else. I've seen family businesses make really bad financial decisions because they want to maintain control. And I think there is this danger that an Indian economy dominated by family businesses making decisions with control as the key objective is going to be dragged down. Second, Indian stock markets are dominated by momentum traders. And you could say that about a lot of stock markets. But in India, there is a bias towards bullish momentum traders and away from bearish traders. If you don't know what I'm talking about, I mean, it's when I see traders come out and push up, tell stories, and often with no financial basis, try to push up the price of companies, and they're viewed as heroes. I've seen the Harshad Mehta documentary, and you can see how bias of pushing prices up, you're celebrated. But on their bearish counterparts, somebody comes out and says, I think stocks are overpriced, or this particular company is overpriced, even with full financial backing, those people seem to be viewed as bad people. In fact, you can see the rules on short selling clearly. While short selling is allowed in India, you're not allowed to do naked short selling. And I think, we can debate whether that's good or bad, but I think we need to remove this bias towards bullish momentum over bearish momentum. Momentum is momentum. Why should we celebrate one and denigrate the other? I also believe that stock market regulators in India, while driven by the best of intentions, have an unholy focus on protecting retail investors from their own mistakes. In fact, I can almost hear the conversation beginning if the Adani scandal continues as, now how do we protect small retail investors from something like this? Something like what? This is a company where retail investors are at best, 2% of the shares of the company? And if you're worried about scams and squeezes that affect retail investors, remember that the retail investors who are most exposed to those scams and squeezes are the ones who seek those scams and squeezes out in the first place. By protecting them from their own mistakes, you're allowing them to keep doing the same bad thing over and over again. So maybe regulation should be less focused on protecting the poor retail investor, because there's no need for a poor retail investor. These are investors who are gambling. They're making bets. If they win, they keep the upside. But if they lose, why are you protecting them on the downside? And finally, on Indian banks. Now, Indian banks have always felt more comfortable lending to family businesses. And it's not because they're corrupt. Some of them might be. It's for two other reasons. One is the bankers who make the big decisions, these banks, and the family group members often hang out in the same social circles. They're in the same networks. It makes it very difficult for the former to be objective with the latter. The second is the perception, fair or not, that when you lend to a family group company, you are more protected because families will step in and bail that company out because of worries about reputation and societal standing. So they will lend to a family group company even if the numbers don't back it up. So, and no amount of central banking lecturing or journalistic articles revealing this practice is going to change that, because you're trying to change decades of learned behavior. So if there's a con here, and as I said, I don't think the word biggest con fits Adani, there is another player in this game where I think you could put the biggest con on. And that's ESGs. And you say, why are you dragging ESG into it? Let me explain why ESG becomes a player in the Adani story. If you take a look at the Adani website and their sales pitch, ESG is now integrated deeply into the sales pitch. They've actually created an ESG universe for their companies. And one of the businesses they're big player in is a green energy business that's funded by green bonds. And I think that the notion that a family group that builds ports and airports, I mean, remember those flights that leave out of the airports contribute to climate change, probably significantly more than whatever you might save on a green energy bond that funds a green energy project. It's the notion that a family group that builds infrastructure, has gas pipelines, that it qualifies for the green bond issuance, tells you less about the group itself and more about the emptiness of the green bond promise. So, I'm always suspicious when I see big segments of reports dedicated to ESG. And that's one of the things in the Adani Group slide decks that drew my attention, is how much time they spent telling us how good they were. And this might be, it's probably not the right thing to wish, but I hope that if Adani happens to default on its debt, that it does so on the green bondholders, since I can't think of a group that deserves default more. Now, of course, you probably started this presentation thinking that I was going to tell you whether to buy Adani or not, and I have no choice but to get to that question, right? So, in fact, there are two questions. One is at the start of this year, when the Adani groups were at their peak, collectively valued at $220 billion, and the Adani Enterprises, the holding companies at $53 billion, was the market overstretched? And the answer is absolutely. But now that the price is down about more than 50%, maybe even 60%, you're saying maybe it's a buy now. So I decided to do a valuation, though not one of any depth, of Adani Enterprises. And it's an upbeat story. This is a story where I haven't incorporated any of the potential backlash from the short selling thesis. I'm assuming basically that I'm valuing company as if Hindenburg hadn't come along. So I went through and valued the company, and I tried to be upbeat. I gave it high revenue growth. Why? Because of political connections and the fact that they're one of the most competent infrastructure players in the game. I gave them margins higher than they are today and higher than the industry average, but I had to be realistic. This is not a business collectively that will make 15, 20, 25% margins. So I gave them 7% margins. With those changes put in, the value that I got, and I did allow for the fact that with their heavy debt load, they're one shock away, one big shock away potentially from failure, where they might, and in failure, I am allowing for liquidation at book value. So overall, pretty upbeat, optimistic valuation. And I get a value of 948 rupees per share. Of course, that's well below the 3,858 rupees the stock was trading at the start of 2023. But even after the markdown at 1,531 rupees, it still looks overpriced to me. Now you're saying, what if there's another 30% drop? I'll make a confession. Even if the price drops further, I will not be tempted to buy Adani shares, even if the stock gets to 950 or 900 rupees. And it's got nothing to do with the Adani Group or the Hindenburg report. It's got to do with the fact that I've likened buying shares in a family group company to getting married. And right after you get married, all of your in-laws move into the bedroom with you. Now, I like my in-laws, but I definitely don't want them in the bedroom with me. You're saying, what are you talking about? Now, one of the things that always troubled me about investing in family group companies, no matter how reputable the family, is the connections you're getting with the company. So rather than just buy the company, you're getting a collection of 15 or 20 other companies that are connected at the hip, hence the in-law statement. And you're exposed legally to the kind of wealth distribution or transfer that can happen across these companies through intra-company transactions. So to invest in a family group company, I would need a significant discount in intrinsic value. And as you can see, the Adani Group is not even close to that point. And if you add on the extra worry about a family group company with political connections, not only do I have to be watching the company, I've got to be watching the election polls, and that's the last thing I want to be doing in my investment portfolio. So for the moment, I'm just going to sit back and watch this fight between the Adani Group and Hindenburg from the sidelines. Not so much because of what will happen to the company, in this case Adani Group, but because I want to see whether it can create changes in business, investing, and regulatory practices in India that can really pave the way for a rising India story to be true. I hope you found this session to be useful, and I thank you very much for listening.